This is Trader's Workshop with Adam H. Grimes. Hello, and welcome to episode 1 of the Trader's Workshop. This episode is what I got right and what I got wrong. I'm your host, Adam Grimes, and you should already be following me on Twitter at Adam H. Grimes. So one of the things about podcasting, my previous podcast had 40 some episodes and I enjoyed doing it, but I got bogged down in a few ways. One of the ways that I realized that I was really losing momentum was in doing show notes. And I would find myself going through this massive production process where for days I would outline, I would play with the outline, and I'd basically write a very extensive blog post and then do a podcast. This is a little bit scary. I'll just be honest with you, because I'm going to do something very different. I see the power of podcasting is kind of in its intimacy. You know, if I do a big internet presentation, I've prepared, I've got the PowerPoint, probably been through that PowerPoint 5 or 6 times, and I really know what I'm doing. Podcasting is different. I could be recording this without pants on. You don't even know, and anything could happen. And I really want to preserve that. So if I talk myself into a corner sometime, I might edit it out. And by the way, I'm known to do that. Like, my business partner, Tom, I feel like many times I talk in multiple sets of parentheses. I do it in writing. I do it in speaking. And the other day I realized that I just been speaking without taking a breath for like 5 minutes. I didn't even remember what we were talking about. And I said, what were we talking about? And he looked kind of confused. He said, I don't know. We were talking about some very important trading idea. And then we were talking about marketing. And then you were talking about your music. And then you were talking about virtuosity. And then you were talking about Schubert. And then we were talking about aliens. And then we were talking about Dyson spheres. And this is quite typical of I don't know how anybody talks to me, actually. And by the way, on the Dyson sphere subject, there's supposedly a lot of missing matter in the universe. Let's just put that out there. I don't know. Like that TV show, I'm not saying it's aliens, but who knows, right? Anyway, I do really intend for this to be kind of off the cuff, and some of it may be ugly and just kind of prepare yourself for that. But what I'm going for here really is the connection. And, I guess the word intimacy is a strange word to use, but it's really not wrong. So this topic, and I feel like I could probably go on for much longer with what I got wrong than what I got right. This is kind of a retrospective over the past few years, how my trading and how my thinking has evolved. And it's also not black and white. The things that I'm going to share with you today, even the things that I got right, many of those hold a seed of some way that my thinking is evolving, some way that I'm seeing things differently. And I hope you find this interesting. I found it pretty interesting to put it together. So what I got wrong, 4 things. I think at times I've been too critical of other trading styles. I have misunderstood what consistency means. A specific technical pattern, the failure test I'm thinking about differently, and the role of intuition in trading. So let's hit each of those a little bit deeper. So too critical of other trading styles. Well, this goes hand in hand with something that I got right that we'll get to in a minute, which is the importance of critical thinking. And one of the things that I've realized, as I said, all this stuff is good and bad. First of all, we just have to admit we live in a world where there are a lot of easy experts. And I hope you heard the air quotes around experts. You may know that there are a lot of books out there. There are a lot of blogs that teach somebody how to be an expert. Theoretically, if I wanted to be an expert on breeding show dogs, there are people who will tell me how to read a few books, how to take a few classes, and how to then gather the right material. And even if I'm profoundly lazy, to outsource it and have somebody else write blog posts that will show that I have a degree of expertise and I'm an instant dog breeding expert. Well, of course I'm not, because we know that what you're really doing is faking expertise, that to build expertise in a subject actually requires going deep. And it requires not only learning the knowledge, but having the experience, making mistakes, and actually, frankly, just what I'm doing here to rethink your thinking and to take things that you have accepted to be true and to think, well, maybe what if I was wrong? Maybe what if it's not quite as true as I thought? That's how we build expertise, and it takes time. It takes years. And my sense is, frankly, that a lot of people who are claiming expertise in trading probably in some sense are either lying or kidding themselves. And the old saying, don't confuse genius with a bull market. And we've had a bull market here for about a decade, right? So I think there are also a lot of people who have existed in one type of market environment. And being naturally contrarian, that is part of my personality that I think aids my trading. But it probably makes me a bit of an insufferable person because, I've told this story before. Like, you and I could be walking and I could say, oh, the sky's a pretty blue. And you would say, yes, the sky is a very pretty color of blue. My reaction is going to be to say, well, wait a minute. Is it really blue? Just because you agree with me, I'm naturally going to disagree with that. And that's something that I honed as a very short-term day trader. As a day trader, you really want to be very contrarian. You need to be very contrarian. But it's something that when I transitioned 10-ish years ago to more of a swing trading style, that I really had to learn to temper. And, it's been very interesting. I've been consistently bullish on stocks for many, many years. And there have certainly been times when the mass of public opinion has also been bullish. Now, what do I do with that? What I do with that is I know that is a nudge. I know that is a nudge to shift me toward bearishness that I need to be very careful of. So I've learned to, I think we learn to manage ourselves, right? We learn to manage our own psychology. And if I'm not aware of that, I'm going to be misled all the time. But, me being too critical of other people's trading styles, I do think many people lie about success, especially on social media. That's undeniable. I think there are people who have services that are scamming clients for various reasons. And I hate that. I hate to see that. But also, success is complicated. And I am convinced that there are people who are successful using methods that probably don't have a statistical edge. And finding a statistical edge, that's an entirely separate discussion, which we will have in our podcast in the future. But there's the parenthetical thing, and now we're 3 parentheses deep. And we have to remember what we were talking about. This is what it's like inside my brain. I think that the revelation that I have had is to appreciate the complexity of success, all of the pieces, and people who are successful many times don't understand why they are successful. They don't understand how they are successful. They can't transmit that success because they don't understand what's really driving it. And, my approach has been to look at the atomic level, to take things apart, to find the meaning within each individual piece. My assumption has been, I've been very careful over the years to always couch it as an assumption, if the individual pieces don't have an edge, the whole itself is not going to have an edge. Or if the whole itself does have an edge and we have pieces that don't have an edge, if we remove those pieces, what we're effectively doing is removing random number generators so our results will become more consistent. Now, you're probably already saying, correctly so, and this is one of the things that that is swimming around in my thinking, is it possible that two things do not have an edge and you put them together and end up with a whole that does? Yes, that certainly is possible, but we can test that and take that apart. Anyway, I think that's a little bit of a long diatribe, but the message, I think, is the complexity of success and the fact that we are dealing with this word complexity shows up a lot, right? When we're dealing with a complex system, that the way we understand that may be wrong. That the way most of us are inclined to take it apart may be wrong. Also, if I were a trader who was trading a system that I had not carefully examined, I would be very nervous about my future prospects for success. Could I build a career? Would I have the psychological confidence to build a career on essentially seat of the pants trading? I probably wouldn't. Some other person might, but yeah, maybe that's a psychological weakness of mine. Number 2, so misunderstanding consistency. And this is something, look, here's a very personal example. So this is being recorded late summer 2018, and I have just launched a new company, and I've had a number of personal things going on, an illness in the family that's required a little bit of travel. And all of this has lined up with about a year and a half ago, I returned to music very seriously. Again, another subject we'll talk about in the future. And I've been trying to figure out how to squeeze in 2 or 3 hours a day of working on my piano playing and piano technique in the context of having an actual life and running businesses. And what I've had to do over the past several weeks as we ramped up to a launch is I haven't spent any time on my music. Now, does that mean I'm not consistent? I don't think so. I think when we think about consistency, and this is not trading discipline. I'm going to loop back into trading discipline in a moment because I think this points out how trading discipline is different. When I think about first level consistency, I just think about doing the same thing all the time. You know, if I am let's say I'm a stonemason, what I do is I put a brick down and I put mortar on the brick and then I put another brick down and I do that over and over. And I show up for work the next day and I do the same job every day. That's what it means to be a professional. But I think particularly in creative ventures or in ventures where we are trying to improve ourselves, an example might be learning to trade. What you can expect is that your motivation will kind of follow a wave. There are going to be times that you are very motivated, and there are going to be external circumstances, as I just mentioned, that may conspire with you and conspire against you. But the reality is, in the long haul, if you're really passionate about doing something, if it's really one of your reasons for existing, you're going to find a way to do it, right? You're going to figure out how to, which, then asks some difficult questions. If there's something you think you're really passionate about and it's not fitting into your life, maybe it's not quite as important as you were, but as you thought it was. But this motivation will come and go. What it means, what the consistency and growth means, is that I don't try to force that motivation. I'm also not concerned. I hear from people who've been trying to learn to trade or learn to invest, and they will kind of reach a low point. They say, I've been working at this for months and months, and sometimes pretty incredible stories. People tell me I've been working 6 hours a day, every day. And you got to be careful because you just reach a point of saturation, or we might say burnout, right? So what I think you need to do is maintain some contact with your objective, with your goal, continue to work, but maybe give it a little bit of space, maybe give it a little bit of space to breathe. I think that's the thing. Even 3 or 4 years ago, I would have told you that consistency meant almost military discipline, that we just do the same thing no matter what. Now I'm thinking if it's a growth or a creative process, we have to respect the rhythms of our lives. We have to respect the rhythms of our motivation. We have to respect the rhythms of our psychology. And that means sometimes you're going to be hot. And when you're hot, you may work like an absolute fiend. And sometimes you're not going to be so hot. And when you're not, you have to have the faith that that passion is still there, that you're going to re-engage with your objective, and you don't completely, I'm not saying go away and don't touch it for weeks or months, but maybe if you've been working very hard at something for 4 hours a day, 6 hours a day, maybe it becomes a point where you work on it a couple hours a week. And you have a few days where you kind of give it room. So I think that's, I don't know if that made any sense. I'm sure it connects with some of you very closely. And I'm sure others of you just listen to me ramble for 5 minutes with no objective. Okay, a specific technical pattern. So the failure test. In my first book, which was written in 2012, the first technical pattern I wrote in the trading pattern section of the book was the failure test. And the failure test is, many of you know this very well, but if you don't, imagine a market that it has gone up and made a potential resistance level. So we can look back in the past and we can draw a line. I'm just going to make up numbers. Let's say number is $30. Let's pretend it's a US traded stock. Okay. And then the market goes down and it goes back up above $30. And on the same, it trades way up. Let's say it trades like $31, $32. On the same day, it closes down below $30. So what happened was it's like the turkey stuck its neck above the fence and got its head shot off. That, the market goes above the level and then there's no conviction and immediately fails. From a practical perspective, what we think happens in many of these cases is the market maybe ran stops, or maybe stops were triggered and then there was no additional liquidity there. And obviously you just flip the same thing up and down. Wyckoff wrote about this concept, springs and upthrusts. So, I'm not inventing anything new, and these are just kind of tests around levels. The failure part of the test is the failure to continue. The test is the test of the previous level. So I taught this pattern as the first pattern I would teach somebody learning about markets because it's an easy pattern to see. There is very little confusion, very little complexity. It's easy to look at a few examples and then go look at the market and find examples of the failure test. In actuality, what I discovered was that my use of this pattern, this simple atomic pattern, was actually deeply tied to elements of market structure. And for somebody to use this pattern effectively, we had to think about where we were using it, what was happening with the trend, and the pattern also does not occur all that often. So would I still put it as the first pattern? Well, in the revised trading, and it was also in the first version of the trading course, it was the first pattern. And I since have flipped that. I'm teaching pullbacks first because the pullback's quite a bit more difficult to understand. And some of you say, no, it's not. Well, be careful. It is difficult if you want to understand the nuance, if you want to understand how to find the best, when, I would say you probably don't want to be looking at the 7th or 8th pullback in an ongoing trend, unless you do sometimes. Precious metals right now might be an example. How do you make that distinction? And you're going to be wrong. How do you handle being wrong? How do you know you're wrong? I think there's actually a lot of subtlety to the pattern compared to the failure test, at least. And I do think that the pullback is one of those simple patterns you can build an entire career around. I know it is. So I would not teach it first. And that is a significant way that my thinking about patterns and about teaching the discipline of trading has evolved. And last, so we're going to break this episode into 2 pieces. I'm just emphasizing all the things I got wrong. Next episode, I'll come back and tell you a few things I got right, because I did get some things right in there. So the role of intuition in trading. This to me is a fascinating subject, and it's absolutely a topic that we're going to talk about more. And I think that it really, what is so fascinating about it? Well, to me, this is even a little bit difficult to put into words, but guess what? It's my job. You got to put it into words. To me, it really raises questions about the limits of knowledge, and it raises epistemological questions about what we know about knowledge. In other words, you know something. How sure are you of what you know, how sure, and how do you acquire that knowledge? How do you grow that knowledge? It also raises questions, fundamental questions about human perception. And that's really interesting. So I always knew, I had this idea when I was learning to trade that master traders just had superior intuition, that there were people who could look at a chart and tell you with a high degree of reliability what was going to happen, that it was almost supernatural and spooky. And I'll tell you, after decades of searching, and you would always hear people say, particularly developing traders, they would speak of a mentor. And I know people have said this about me. I know some of the people who have worked with me, who have read my work, who've listened to me talk about about markets. They would say that about my read of markets. And I would say it's not true. I would contradict that strongly. People would say, oh, Adam has such an intuition about markets. And I don't sense that myself. And I also, in tracking down other people, I've never found anybody whose intuition is super reliable. What I have found is people who have superior trading skill, where they can take market intuition and they know what to do with it. One very easy way to think about this is, if you're a beginning trader, you're very nervous. Right? I'm dropping a lot of topics here that we're going to revisit in the podcast in the future. And I've related this story before, that when I started trading, I was shocked at my physical, emotional reactions to stress. I had never had those reactions in any other context before. And I was not risking a huge, significant amount of money. So to see my breathing, my whole physiology, like retune into this massive fight or flight or just breakdown mode, was really fascinating when I could observe it from a distance, but it wrecked my chances of success. And, if you're a beginning trader and you're in that emotional state, and most beginning traders are in some variation of that emotional state. And by the way, if that's you, you're completely normal. Congratulations. That's just the way it is. You can't have intuition. You're just trying to hold it together. You have no room to have intuition when you're in that mental space. So I do think and I definitely have experienced traders who rely more on intuition, but really I don't know that their intuition is that superior. It's maybe a little nudge from intuition combined with a little bit of trading skill. Actually, let's just call it what it is, with significant trading skill. Some other thoughts about intuition. When I was doing the research for the first book, I looked at a lot of the literature on intuition, and there is quite a bit of research that proves that intuition is a real thing, that market intuition is a real thing. And a couple studies jump to mind. Andrew Lo. If you don't know Andrew Lo, you should. You should Google him, L-O. I would say one of the leading lights in behavioral finance and also in quantitative finance. Definitely, some of his books a lot of his work is very, very accessible. I have a book here. Actually, a couple of his books here, but there's a very interesting history of technical analysis and one on adaptive markets. I couldn't see the title. It was buried under a pile, but definitely read his work. He did a study which was called Aurelia, I think, where he had people log in and play a game. That the game was to tell if market data was randomly generated or real data. And if we've all seen the examples in books, and I have some examples in my work too, where like I'll show you a randomly generated chart and a real chart, and you tell me which it is. People have a lot of trouble doing that. And the point of that illustration when we use it is to point out that a lot of these things that you think are patterns, trends, pullbacks, double tops, triple tops, heads and shoulders, these things also exist in random data. So the presence of a trend, for instance, doesn't necessarily mean that the market's not just random walking. And many people can never really get past that understanding. I've had a lot of people kind of get stuck there. But once you can accept that, then you go to the next level, which is what Andrew Lowe was getting at. People were able to tell the difference with a pretty high degree of reliability. And what I think you would see if you start to really examine random data versus actual price charts is you would see some differences. You would see some differences in terms of patterns. And by the way, every one of those points to a potential trading edge. And where I see on just casual inspection a big difference is in the way volatility evolves. If you're looking at randomly generated data, it could be generated lots of different ways. And if we're using something like a Garch model, then you've handled the volatility in a way that would erase this edge. But let's say you use a standard way of generating random data, might be to kind of scramble bars. So if you imagine we just take a price chart, take all the bars off and put it in a bag and shake it up, reach into the bag, draw out a bar, put it on the chart, draw it on the chart, I guess, and then put the bar back in the bag, shake the bag again, take another bar out. And so the bar would also include the relationship to the previous bar. That's how you would reference that. From quantitative perspective, you look at the change from the previous close. That's how you define the bar. The change from the previous close to the current close, open, high, low. And you just kind of randomly draw bars like that. You might flip them. If you look at that, what you've really done is you preserved the distribution of bars, of returns, but you have removed any serial correlation. And if you compare that to real data, frankly, it's quite easy to tell the difference. You will see what to your eye will look like bizarre combinations of big bars and little bars. And you might say, that doesn't really happen in markets. Now, you do this a lot, you're going to be wrong, right? You're going to see some examples where you'll say, oh, that doesn't really happen in markets, and strange things do happen. But you'll get it right a lot more than you'll get it wrong. And even, I'm saying even if you have basically no trading experience, you could take somebody with no experience and train them in a matter of minutes to hours. And there was another study that was done where they did just this. They looked at random data or data that has insiders pushing the market around. And people were able to easily intuit the presence of that manipulation, if you will. And, of course, I'm grossly oversimplifying the research, but I mentioned it in my first book, and I think I'm oversimplifying, but I'm not misrepresenting. So the point is, market intuition is a real thing. And one of my good friends, Joe, who was one of the readers for my first book, called me at some ridiculous time in the middle of the night, and he said, you know what? If market intuition is a real thing, then everybody has it. And I said, yes, okay. And he said, if everybody has it, it's not an edge. Boom. And that really shaped that was one of those moments that really shaped my perception and sense of intuition over the next 5 or 6 years. I came to think that this is something that everybody has. There's nothing special about it. And therefore, it's not the source of a trading edge. However, I can also tell you that I have had repeated experiences at market turning points or points where markets do not turn, where I've had the undeniable voice of intuition. And I record my market thoughts every day, so I'm not making this up. I record them publicly. People see this. And one of the things, my research has been published on Real Vision for many years, and one of the comments that I get from people consistently is, you've been the only technical advisor we read who has been consistently right about market direction. How did you do that? Well, I can point to a lot of quantitative things. I can point to a lot of models. I can point to a lot of fundamental models. I can point to a lot of technical models. I can point to a lot of patterns. I can point to a lot of combinations of multiple timeframes. I can point to a lot of spread relationships against market or between different markets. But the reality also is that there has been and it may mislead me someday, but there has been also a piece of intuition. Now, if I'm ranking those, I will tell you that piece of intuition is probably many, many steps down. But I think it's there. And I think that perhaps over recent years that I have been distrustful enough of intuition in my ongoing rage to quantify, to understand the limits of what we can really understand and measure and know with some degree of statistical scientific certainty. I think I've neglected the role of intuition. And that's that kind of wraps us up here for this podcast. So I hope that was interesting. I need you to do a couple things for me. I need you to go to iTunes, which is probably where you found this. Please subscribe. Please like. Please tell everybody you know who you think would like this podcast. Though after what you just heard, I don't know, maybe it's a short list, but seriously, if you, if you are involved in trading communities, please help me spread the word. Please help me get the podcast out. And also check out my blog, adamhgrimes.com. One of the things I'm going to do for you in this podcast is I'm not going to bombard you with sponsors. We thought about that in shaping the podcast because, sponsorship, a lot of podcasts are sponsored, and there are a lot of people who every day I get emails from people who are wanting to advertise on my sites, and I don't do that. So I'm going to be my own sponsor. I'm going to tell you about some of the commercial things I do later in other podcasts. But for now, just follow, subscribe to the podcast, I guess. Follow me on Twitter and check out my blog at adamhgrimes.com. Thank you very much. I will see you back for episode 2, where I'll tell you a few things I got right.
It's never hard.